What does the profit graph of a calendar spread look like? Have you ever wondered how a calendar spread works in options trading? Let's break it down and take a closer look at what the profit graph looks like. A calendar spread is a strategy that involves buying and selling options with the same strike price but different expiration dates. This approach allows traders to benefit from time decay and changes in volatility. In a calendar spread, you will have a long position and a short position. The long position means you buy an option with a longer expiration date. The short position means you sell an option with a shorter expiration date. The profit graph for this strategy can be quite interesting due to the involvement of multiple expiration dates. When you look at the profit potential, it can be unlimited if the underlying asset moves in the desired direction after the short option expires. However, predicting the actual profit can be tricky. It largely depends on the remaining extrinsic value of the long option after the short option expires. On the flip side, the loss potential is limited to the net debit paid for the spread. This maximum loss occurs when both options expire out of the money and become worthless. So, it is important to manage your risk effectively. The calendar spread is most profitable when the underlying asset remains near the strike price until the short option expires. This stability allows you to collect the premium from the short option. If the asset then moves favorably before the long option expires, you can make additional profits. Using a calendar spread on platforms like Robinhood can be a smart move. For instance, if a stock is trading close to a strike price, you might sell a short-term call option and buy a longer-term call option with the same strike price. If the stock remains stable until the short-term option expires, you can collect the premium and potentially benefit from any price increase before the longer-term option expires. When setting up a calendar spread, consider the strike price carefully. Ideally, it should be close to the current market price of the underlying asset. The difference in expiration dates is what allows you to profit from time decay and changes in volatility. Remember, the maximum loss is the initial debit paid for the spread, which gives you a defined risk. Overall, the profit graph of a calendar spread reflects a strategy that can be effective under specific market conditions, especially when the underlying asset stays stable near the strike price until the short option expires. This can lead to a favorable price movement that benefits your long position.